I need you to stop what you're doing right now and give me your full attention for the next several minutes, because what I'm about to lay out for you is something that the mainstream financial media is either too afraid to say or too compromised to acknowledge. The 2008 financial crisis did not come out of nowhere. It did not appear overnight. It was not a surprise to anyone who was paying attention to the data. The warning signs were visible for at least 2 years before Lehman Brothers collapsed and the global financial system nearly went into cardiac arrest. The problem was that most people were not paying attention. They were told the economy was strong. They were told the housing market was solid. They were told that the sophisticated risk management systems on Wall Street had eliminated the possibility of a systemic failure. And then in September of 2008, the entire system came within hours of complete shutdown. I'm telling you this because every single warning sign that preceded the 2008 collapse is flashing right now. Not some of them, not a few of them, every single one. And the pattern is not just similar, it is structurally identical. The same types of loans are going bad. The same types of securities are losing value. The same types of banks are under stress. And the same types of assurances are being given by the same types of people who told you everything was fine in 2007. But here is where this gets significantly worse than 2008. In 2008, the United States government had the fiscal capacity to intervene on a massive scale. The federal debt was approximately $10 trillion. The Federal Reserve had room to cut interest rates from over 5% down to zero. The Treasury Department had the political capital and the financial flexibility to orchestrate bailouts, guarantees, and emergency programs that prevented the system from collapsing entirely. Those interventions were controversial, and they were expensive. But they worked. They stopped the bleeding, and they gave the system time to heal. That capacity does not exist today. Not even close. Federal debt has ballooned to over $36 trillion. The deficit is running at nearly $2 trillion per year. Interest payments on the national debt now exceed the entire defense budget. The Federal Reserve has already used its most powerful tools and is running out of ammunition. And the political environment has shifted so dramatically that the idea of another massive bank bailout is essentially dead on arrival in Congress. The public will not accept it. The politicians know it. And the banks know it too, which is why what's happening right now behind the scenes is fundamentally different from anything we've seen before. In 2008, the playbook was simple. Banks take excessive risk, the risk blows up, the government steps in and saves the banks. Taxpayers absorb the cost. The system resets and the cycle starts again. That playbook worked because there was a backstop. There was a buyer of last resort. There was someone standing behind the curtain with a checkbook big enough to cover the losses. That someone no longer exists. The checkbook is empty, the backstop has been removed, and the banks are taking on risk levels that make 2008 look conservative by comparison. Over the next several minutes, I'm going to walk you through the exact parallels between what happened in 2006, 2007, and 2008, and what is happening right now in 2025 and 2026. I'm going to show you the data points that are identical, the structural similarities that cannot be ignored, and the one critical difference that makes this situation potentially far more dangerous than anything the modern financial system has ever faced. And then I'm going to tell you exactly what I believe you need to do to protect yourself. Because the window for preparation is closing, and once the dominoes start falling, the exits will be crowded and the liquidity will be gone. This is not about predicting the future. This is about reading the present accurately. The data is right there in front of us. The question is whether you're going to look at it honestly or whether you're going to do what most people did in 2007 and assume that because things have been fine for a long time, they will continue to be fine forever. History has a very clear answer to that assumption, and it is not a comforting one. Let me walk you through the parallels one by one, because when you see them laid out next to each other, the pattern becomes impossible to deny. In 2005 and 2006, the housing market was showing clear signs of overheating. Prices had disconnected from fundamentals. Lending standards had deteriorated to the point where people with no income, no job, and no assets were being approved for mortgages. The financial industry had created complex securities that packaged these risky loans and sold them to investors around the world as safe investments. And the rating agencies had stamped AAA ratings on bonds that were backed by loans that should never have been made. Today, the parallel is not in housing. It is in commercial real estate. Office buildings across the country are sitting half empty as remote work has permanently reduced demand for office space. Retail centers are losing tenants as consumer spending shifts online. Even multifamily properties in certain markets are seeing rising vacancy rates and falling rents. The valuations on these properties have dropped 30 to 40% from their peaks in many markets. And the loans backing these properties were made during the zero interest rate era when borrowing was essentially free and valuations were inflated by cheap money. In 2007, the first cracks appeared when two Bear Stearns hedge funds that were heavily invested in subprime mortgage securities collapsed. The market initially shrugged it off as an isolated incident. A containable problem, nothing systemic, but it was systemic. It was the first domino in a chain that would eventually bring down the entire financial system. Today, the equivalent of those Bear Stearns hedge funds is the regional banking sector. In March 2023, Silicon Valley Bank collapsed in the second largest bank failure in United States history. It was followed within weeks by Signature Bank and First Republic. The market was told these were isolated incidents, unique circumstances, poor risk management at specific institutions. But the underlying problem was not unique to those banks. The underlying problem was that banks across the country had loaded up on long-duration securities during the zero-rate era, and when rates spiked, the market value of those securities cratered. According to the FDIC United States, banks were collectively sitting on approximately $650 billion in unrealized losses on their securities portfolios as of the third quarter of 2025. $650 billion. That is not an isolated problem. That is a systemic condition affecting the entire banking industry. In 2007 and 2008, the credit markets began to seize up as investors realized that the securities they were holding were worth far less than they had been told. Credit spreads widened dramatically. Lending between banks dried up as trust evaporated. The commercial paper market froze, and businesses that relied on short-term credit to fund their operations suddenly found themselves unable to borrow at any price. Today, credit spreads are widening again. High-yield bond spreads have expanded significantly over the past 6 months. The leveraged loan market is showing stress. Credit card delinquencies have surged past 7% nationally, with some major issuers reporting delinquency rates above 10%. Auto loan defaults are at their highest level since 2010, and corporate bankruptcies are running at levels not seen since the aftermath of the 2008 crisis. In 2008, the Federal Reserve responded by cutting interest rates aggressively from over 5% to zero, and launching massive quantitative easing programs that injected trillions of dollars of liquidity into the financial system. The government passed the Troubled Asset Relief Program, which authorized $700 billion in direct support to financial institutions. The FDIC expanded deposit insurance, and the Treasury Department guaranteed money market funds to prevent a run on the shadow banking system. Today, the Federal Reserve has already cut rates, but they started from a lower peak, and they are constrained by inflation that remains above target. Cutting rates aggressively risks reigniting inflationary pressures that would erode consumer purchasing power and political support. Quantitative easing on the scale of 2008 through 2014 would explode the money supply at a time when the dollar's reserve currency status is already being questioned by major trading partners. And a TARP-style bailout program would require congressional approval that is virtually impossible in the current political climate. The tools that saved the system in 2008 are either depleted, constrained, or politically unavailable. And that is the critical difference that separates this moment from every previous financial crisis in modern American history. The playbook is the same. The risks are the same. The leverage is actually higher, but the safety net has been removed. Now let me show you why the math makes a bailout virtually impossible this time around, because this is where the situation goes from concerning to genuinely alarming. In 2008, when the government intervened to save the financial system, the federal debt was approximately $10 trillion. That was already considered dangerously high at the time, but it provided enough fiscal flexibility for the government to borrow massively to fund the bailout programs without triggering a sovereign debt crisis. Today, the federal debt exceeds $36 trillion. It has more than tripled in less than 2 decades. Annual interest payments on that debt now exceed $1.1 trillion. To put that in perspective, the federal government is now spending more on interest payments than it spends on national defense, more than it spends on Medicare, more than it spends on every discretionary program combined. This is not sustainable, and everyone who is paying attention to the bond market knows it. The yield curve, the relationship between short-term and long-term interest rates, has been sending distress signals for over 2 years. An inverted yield curve, where short-term rates exceed long-term rates, has preceded every recession in the past 50 years, and the current inversion has been one of the deepest and longest lasting in history. But here is the mechanism that connects the government's debt problem to your bank deposits and your financial security. When the government needs to borrow money, it issues treasury bonds. Those bonds compete with every other borrower in the economy for available capital. When the government is issuing $2 trillion in new debt every year just to fund the deficit, it sucks enormous amounts of capital out of the private sector. That capital is no longer available for business lending, for mortgages, for consumer credit, or for the short-term funding markets that banks rely on to operate. This creates what economists call a crowding out effect. The government's borrowing pushes up interest rates for everyone else. Businesses pay more to borrow. Consumers pay more for mortgages and car loans, and banks face higher funding costs that squeeze their profit margins and reduce their ability to absorb losses. In an environment where banks are already sitting on $650 billion in unrealized losses and operating with reserve requirements of just 3%, the crowding out effect is not a theoretical concern. It is an active accelerant that is making the banking system more fragile with every passing month. And then there is the maturity wall. Over $1.5 trillion in commercial real estate debt is maturing in 2026 and 2027. The vast majority of these loans were originated during the zero-rate era at interest rates between 3 and 4%. Today, the prevailing rate for commercial real estate lending is between 7 and 9% for a borrower with a $50 million loan that is coming due. The difference between refinancing at 3% and refinancing at 8% is an additional $2.5 million in annual interest expense. Many of these borrowers simply cannot afford that increase. Their properties are not generating enough income to service the higher payments, and the value of their properties has declined 30 to 40% since the loans were originated, which means they cannot refinance without injecting massive amounts of new equity. The result is predictable, and it is already happening. Borrowers are defaulting. They are handing the keys back to the lenders. And the lenders, which are predominantly regional and community banks, are being forced to take ownership of properties that are worth significantly less than the outstanding loan balances. These losses flow directly onto bank balance sheets. And because reserve requirements have been cut to 3%, the banks have almost no cushion to absorb them. This is the same dynamic that destroyed the savings and loan industry in the 1980s, the same dynamic that triggered the 2008 crisis. And it is playing out right now in slow motion across the American banking system. The difference is that in previous crises, there was a mechanism for the government to step in and absorb the losses. Today, that mechanism is constrained by $36 trillion in existing debt and a political system that has no appetite for another bailout. The math is simple and it is unforgiving. The losses are coming, the buffers have been removed, and the backstop that everyone is counting on may not be there when it's needed. This is not a prediction, this is arithmetic. So the question that matters right now is not whether the parallels to 2008 are real. They are real, and they are documented in data that anyone can verify. The question is, what are you going to do about it while you still have the ability to act? Because the lesson of every financial crisis in history is that the people who prepare before the crisis hits are the ones who survive it. The people who wait until the crisis is obvious to everyone are the ones who get destroyed by it. And I want to be very clear about something. Preparation is not panic. Moving your chess pieces before the board gets flipped is not irrational behavior. It is the most rational thing you can do when the data is telling you that systemic risk is elevated and the traditional safety nets have been compromised. So let me walk you through the specific actions that I believe make sense in this environment. First, you need to understand your exposure to the banking system and reduce it where possible. If you have deposits above the FDIC insurance limit of $250,000 at any single institution, you are an unsecured creditor for every dollar above that threshold. In a bank failure, those uninsured deposits are at risk. They can be frozen for weeks or months. They can take a haircut in a resolution process. Or under bail and provisions, they can be converted into equity in the failing bank. The action is simple. Spread your deposits across multiple insured institutions. Use the FDIC limit as your maximum exposure per bank. And consider moving excess funds out of the banking system entirely into assets that do not depend on the solvency of a financial institution. Second, you need to own physical precious metals held outside the banking system. This is not a trade. This is not speculation. This is insurance against the specific scenario we have been discussing. When the banking system is fragile, when reserve requirements are at historic lows, when government debt constrains the ability to mount a bailout, physical gold and silver become the only assets with zero counterparty risk. They do not depend on a bank remaining solvent. They do not depend on a government maintaining fiscal discipline. They do not depend on a central bank making the right policy decisions. They simply exist as stores of value that have maintained purchasing power across 5,000 years of monetary history. Central banks themselves are buying gold at record pace right now. Over 1,000 metric tons purchased in 2024 alone. They understand what is coming, even if they will never say it publicly. Third, you need to shorten the duration of your financial assets. If you are holding long-term bonds or bond funds, you're exposed to the worst possible combination of risks. Rising credit risk as defaults increase, rising inflation risk as the government monetizes its debt, and rising interest rate risk if the Federal Reserve is forced to change course. Move into short-duration, high-quality instruments, treasury bills with maturities under 1 year, short-term investment-grade corporate bonds, money market funds backed by government securities. The goal is to preserve capital and maintain liquidity so that when opportunities emerge from the crisis, you have the ability to act. Fourth, build a position in hard assets with intrinsic value and cash-generating capability. productive farmland, energy royalties, essential infrastructure. These assets produce real economic value, regardless of what happens in the financial markets. They cannot be printed into existence by a central bank. They cannot be diluted by government borrowing. And they tend to appreciate during periods of currency debasement and financial instability, which is exactly the environment we are heading into. And fifth, eliminate single points of failure in your financial architecture. Diversify across institutions, diversify across asset classes, diversify across jurisdictions where legally appropriate. If your entire financial life is concentrated in one bank, one brokerage, and one country, you are maximally exposed to a single point of failure. Build redundancy into your financial structure so that no single event can threaten your entire net worth. Now, here's my question for you, and I want you to answer honestly in the comments, because this community has become one of the most thoughtful and informed groups I have encountered anywhere. When you look at the parallels between 2008 and today, when you look at the debt levels, the unrealized losses, the reserve requirement cuts, and the political constraints on a future bailout, do you believe the system can navigate through this without a major crisis? Or do you believe we are heading towards something that could be significantly worse than 2008? Tell me what you think, and more importantly, tell me what you're doing about it. If this breakdown helped you see the situation more clearly, share it with someone who needs to hear it. Subscribe if you want to stay ahead of this, because I am tracking every data point in real time, and as new information emerges, I will be here breaking it down. The 2008 playbook is repeating. The parallels are undeniable, but this time the safety net has holes in it that are too big to ignore. The question is not whether the stress is coming. The question is whether you will be positioned to survive it when it arrives. Stay sharp, stay informed, and stay ahead of the curve. I will see you in the next one.